Everyone tells you to never touch your retirement account. And sure, compound growth in a 401k or Roth IRA is powerful, but here's the real question. Is $20,000 better sitting in your 401k, or would that $20,000 be a better investment as a down payment on a home? Today, we're putting those numbers side by side, retirement growth versus home equity, to see which one really helps you build wealth faster. And to help us break it all down, because obviously me and Bill are just salesmen, we've brought a special guest. This is Joe Caldera, a board-certified financial planner, licensed advisor through LPL Financial. For 26 years, he's been helping people in their pursuit of their financial goals. Joe's here to give us the financial planner's perspective on whether you should tap into your retirement to buy a home or if it's worth it there to just let us sit. Joe, thank you for your time. I appreciate you, brother.
Yeah, I'm glad to help.
Joe, can you give the people just a little bit of your background? Like, we want to trust build here. We want them to understand who you are and what got you into this job.
Yeah, so I thought my path was the FBI. And when I learned the power of compounding, the rule of 72, I was like, this is the best kept secret. So the rule of 72 is if I got a 7.2% return on my investment, my money will double every decade, every 10 years. And so, 5 becomes 10, 10 becomes 20, 20 becomes 40. And as a young 20-year-old, I was like, man, this is amazing. But then I realized, well, what happens if I got a 10% return? Well, then money doubles every 7.2 years. So now I can add another period, and that 40 becomes 80 or maybe 160. And so the power of compounding just shifted me to financial planning.
So Brandon, did I tell you that he's a nerd?
Yeah.
we needed the money guy to come in and actually put us in our place.
This is officially the smartest person we've ever had on the show, so I'm very excited for this. So what we want to start off with, and the big thing we do here is educating an audience who may not have gotten the same financial education that you clearly are bringing to the table. So from just a baseline perspective, how does my 401k grow? You talk about the rule of 72. Okay, how am I making that interest? How does the 401k grow for me?
Yeah, well, first, your employer has to sponsor a retirement plan. You just can't go out on the street and say, hey, I'm going to join a 401k.
Okay.
So number one, you got to find an employer who's going to have that qualified plan for you to take a piece of your pay and put it into a 401k. Now, 401k just refers to section IRS code 401 section K. Okay, so that's number one. And in that section and in those codes are a lot of limits in what you can and cannot do. So for instance, in 2025, the maximum that you can put away is $23,000. Okay, now if you're younger than 50, if you're older than 50, you can add another $7,500 to that. So I'm sorry, $23,500. They just increased it $500 from 24 to 25. But how your money grows, essentially, in your retirement program, the employer will have you create a menu, an investment menu, where you get to select investments from. So you can select large cap, mid cap, small caps, emerging markets, international investments, maybe some bonds, some cash alternatives, or maybe even a target date fund, which a target date fund basically is one investment that is tied to your retirement age. And so let's say I'm going to retire, let's say this year it's 2025, but let's say I'm going to retire in 2045, so 20 years from now. Then I would look at a 2045 target date fund. And what happens is that when you put money into a target date fund, it gets less risky as you get closer to retirement age. But what are you actually investing in? So if you think about companies like, say, Apple or Netflix or NVIDIA has been a very popular
that's for me.
Holding,
That's a good one. Okay. That's for me.
So these companies have what's called shares. These are public shares where you and I as an investor can actually own a piece of that company. And what causes the shares to rise or fall is basically the demand for those companies. So when a company does really, really well, sells lots of product, is widely distributed, the price of the stock and profitability could play a role into that too. Sometimes we see companies that don't have any profitability and just the assumption that there might be profit, like Tesla, for instance. One day, they were facing bankruptcy back a long time ago, and you look at it today, and it's one of the largest. But that's how your money grows. And so when you put park money into a retirement account, you're buying shares, and you're buying diversified shares.
This is the question for the dummies in the audience like me, right? I'm the stand-in for the dummies. Why is it that NVIDIA, who is this massive company worth this, why are their shares hovering in what now, like it was at the high hundreds or something like that, but Costco's in like the thousands? Is it because, or 1,041? Is it because Costco has fewer shares to go around?
So every company has a certain amount of shares.
Okay.
Now, NVIDIA ended up splitting their shares. So let's say there was 100 million shares available, and they wanted to bring the price down from, let's say, $200 or $1,000 down to $100,
Okay.
right? Because $1,000 to buy one share may not be affordable for maybe most people. So maybe $100 a share could be attractive.
Bring more people in.
Right.
Yeah.
So what happens though if you had shares in the company and it went from 1,000 and to $100 a share? Well, now you have 10 times more shares, right? Because it has to equal
Okay.
the same amount. So Costco, for instance, depends on the total amount of shares times the price of those shares equals what's called the market cap. So when you multiply total outstanding shares by the price equals the market cap.
Oh, see? Look
We
at
learned
hey,
something.
to all the other dummies like me. Look at that. We're learning today. We're learning today. So now you guys know how 401ks grow, and now you've learned a little bit about market share and market cap, which is a bonus we have here. Bill, how does housing equity grow?
So housing equity is essentially where when you buy a home, let's say, for example, you buy a home for $400,000, you put your money down on it, you're buying the home. Now, the different equity is the difference between the value of the home and your loan amount. Okay.
So like if I bought Tesla at 220 earlier this year, and then now it's at something like 420, I think.
Yeah.
Is it that? Is it like
It's
that $200
the difference between 220 and the
and
420.
420? Okay.
So $200, if you will, a share equity in there. Same thing with a house. If you bought it for $400,000, right?
Yeah.
And the property goes up in value, say 4%, right? So it would go from $400,000 times 0.04, it'd go to $416,000. That equity position is $16,000. But you also have the mortgage where you put money down and you're paying your mortgage down. So you can actually get more equity as time goes on because you're paying that mortgage down.
Okay. So in both situations, I'm growing my money, but it seems completely different, right? Because with the housing equity, and I think this is why dummies like me, when I hear Roth IRA or I hear stocks or something, it's so hard because it feels like numbers in the sky.
Yeah.
Like true. And I know it's not. When you explain it to me, it makes sense, right? But when I was growing up as someone who grew up with like no financial education, when you told me, hey, buy a house, it makes money, I'm like, oh, well, that makes sense. I'm living in it. I'm sitting in it. I'm growing up in it. I can touch it, right? And then when someone's like, well, no, okay, you need to take your money and put it in this account over here, and every 10 years it's gonna make more money. And I'm like, well, how? What am I doing for it to make money? Is that a hurdle you often have to overcome with people, or do the people you work with kind of already know how this works?
Well, there's a lot of parts and pieces to financial planning. What we're describing is appreciation.
Okay.
How does a home appreciate in value? And how does a stock or your 401k appreciate in value? So we talked about how stocks, can go up and down. A lot of things can influence that. The economy can influence that. The price of the underlying management, the product itself. Drug companies are vulnerable to successes and wins, right? But even in housing market, right? Things could not go so well if
interest rates go up.
Well, and if you have a supply and demand on both sides, right? So if the demand for housing is lower, then there could be a softening. Where and this year we're facing. You would probably argue that it's a buyer's market, right?
Yes.
And so we hear these terms, buyer's market and seller's market, and what does that mean? It just means that how easy is it for you to sell your home compared to, how many days it's on the market.
Yeah, and I think simply put, a buyer's market, right, is when there are more sellers than buyers, and they have the pick of the litter. A seller's market is when there are less homes to sell and like a multitude of buyers over here. So, and that supply and demand can determine value and what the cost of that home is going to be. And in our market, Brandon, as you know, with the interest rates when they rose over the last 4 years, it has really like made the affordability for the average buyer less. And so people get concerned about it. Now what we're seeing is there's more sellers than there were buyers. And so now the buyers have the advantage right now in many cases.
Yeah. Well, it's not just a little advantage; it's a gross advantage. On the financial side, do the markets work the same way? So, for instance, is there like a quote unquote buyer's market on retirement plans, saving plans, financially, or is it always pretty much the same? Is it pretty even keeled?
In our world, the market is going to react to events. And in April, we had a lot of discussions about tariffs and what tariffs were going to do, and could that create inflation? Can that bring down the economy? And what's happened since we got more clarity on these tariffs is that since April, the market has actually gone up to the point where we actually hit all-time highs, both in the tech, the NASDAQ, the S&P, the Dow Jones. These are indexes where companies have their trading stocks on those platforms, or the NASDAQ the New York Stock Exchange is one of the exchanges where stocks are traded. So can the stock go higher? Absolutely. Can the stock fall? Possibly.
Sure.
And that's why interest rates were just cut 0.25% just recently. Why? Because labor is starting to, the people are having a tougher time to find work and jobs, right? So we're starting to see that. Inflation seems to be sort of at bay. They would like to be a little lower, but right now that labor market is a concern. So what does that mean? Well, if people don't have jobs, then they're not actually going out and spending.
Sure. Does that affect someone's 401k? Like, can your 401k be thrown off by these markets? Or is a 401k almost like, is there a box around the money that you're investing to protect it or shield it from the volatility of these markets?
Well, the cool thing is that we get to choose and select how much volatility do we want to experience. And if you think about a rubber band, think about how a rubber band can stretch, right? The elasticity of a rubber band. Now, someone who's near retirement age may not want to have the full exposure of the market. And so what they do is they'll kind of like shave off some of that growth and add other investments that are not subject to that type of volatility.
So much safer.
So the risk reward can be customized to your profile.
What are some of the safer places that people over 50 tend to put their money?
Well, 50s is still young. So,
good, because I'm in my 60s. So.
Well, I mean, we're living a lot longer, right? And so I have clients, age 100. And so you think about retiring, right? Even at 65, full Social Security age is actually 67.
Okay.
And then you're forced to take Social Security if you delay it till 70. And there's some cool ideas about, strategies in terms of Social Security. We all pay into Social Security, but Social Security was not designed to help pay for 100% of your retirement. It's about a third. But going back to the question, I think that there are money markets, interest rates were high. And so clients were getting, in the neighborhood of in the 4%. We had CDs at one time over 5, right? Now, obviously, as interest rates are starting to come down, all of these money market instruments, treasuries, bonds, both short-term, mid-term, intermediate term, these are sort of the places where clients will seek to find more stability.
Mm-hmm.
So what's a volatile one? So Tesla was on, they were kind of growing, but yet there were people that thought that it was going to be really good. I would imagine cryptocurrency is more volatile. Is that the one where sometimes you don't want to have all your money in there?
Well, I mean, if you were early
investor,
investor, right, into Tesla,
if you're 60s,
you're doing pretty well.
Not.
If you bought Bitcoin, early on, you're doing quite well. So, it's all depends on your risk profile. So not all investors do well, and sometimes they get in the way of their own investments. They're the psychology of investing. So what I see, unfortunately, is people who come to me who buy high and sell low. Right? You want to do opposite. You want to buy low and sell high.
Right.
We get that. We get that too on our end. It's the one big thing that we're trying to fight. In fact, we're fighting it a lot right now in real estate. Is that we have people who bought listings at the peak, right? And now they want to sell now at the nadir. And it's like, well, no, you kind of want to do the exact opposite of what we're doing right now, right? Let's use Las Vegas as a case study because that's where all three of us are located. I know you guys can work outside of Las Vegas. I'm stuck here, so let's just be selfish for a few seconds. The median home price in June 2020 in Las Vegas was $325,000. As of 2025, the median home in Las Vegas is now approaching $485,000 for a 49% growth. If you use the $20K in 2020, your equity in 2025 would easily be over $100,000 compared to about $28,000 if left in retirement. These are the numbers that I want people to go over because obviously every 5 years isn't going to be like the last 5 years in real estate. We're talking about one of the largest real estate booms in modern history. So we can't pretend like this is going to be standard, right? But even if we're looking at a typical 3 to 5% growth year after year, it feels like on our end, and again, we're biased because we're in real estate, it feels like some of the 401k money feels safer. Not all of it, because obviously markets can be volatile. It just feels like it can be safer being used for a down payment. I know it's something Bill talks about. How do you feel about that?
I think it's an excellent vehicle, especially for first-time home buyers who are they come out of schooling, maybe some trade school or maybe formal education, and they start putting a piece of their pay because maybe their employer matches, right? The employer might match a 3%, maybe 4%. So if I put away 4%, I get another 4% from my employer. Now I have 8%, in my 401k.
Okay.
And over time, when you grow that 401k, you can use possibly the money out of that 401k to use as a down payment on a purchase of a home. So you can also do it in an IRA as well. So an IRA, you can borrow or you can take out $10,000. And if it's a traditional IRA, you can pay the tax on the $10,000 because you got the tax deduction. But in a Roth, if you had the account for 5 years, you can take money out and avoid the 10% penalty. So what you're taking out is your principal out of the Roth as a down payment. So it's an excellent way because two things happen. Number one, you make the contribution for hopefully, for retirement, you start that. But now you have a pot of money that you can use towards a down payment. Now, not all 401ks offer loans. So you have to check with your administrator to see if your 401k offers loans. But you can borrow up to 50% of your vested account balance in your 401k, up to $50,000.
Up to $50,000.
Up to $50,000.
How would an employee? Again, I'm a dummy, right? How would I know what question or how would I know what to ask to say, hey, does my 401k allow me to do this, right? Before you said this, I'm not sure me or anybody watching even knew that this was an option or that different retirement plans allowed for different levels of borrowing, right? How would I know what question to ask?
Yeah, it should be in your plan summary documents. And if you're not sure if you have those documents, you can certainly ask your HR department.
That's like when you get an Apple phone and they ask you to read through all the stuff and we all just scroll to the bottom and click accept because we're not reading through it. I think a lot of people treat their plan summaries like that. Are you saying we should actually read those things?
Well, I think it's number one, it's important to see if your employer's offering a match. And if it offers a loan, certainly it's something that you would definitely
Is
want
that
to
something
consider.
we can pay smart people like you to read for us?
Well, it's not that very difficult, but my team is glad to help.
But here's where I'm going to go. So Brandon and I have talked about it a lot. And people generally spend things on things they don't really need. They'll spend it on events, they'll spend it on cars, watches, shirts, shoes. They spend it on a lot of things.
Uber Eats.
So Uber Eats, that's right. Uber Eats over there. Okay. So they spend it like not necessarily wisely. Okay, that's fine. So they don't have a lot of money outside of the retirement. They may have $5,000. They don't have enough money for the down payment, but yet they're with an employer. They've got a good job. They got good credit. They've got, $25,000, $30,000, $40,000 in their 401k, but they don't have enough money for the down payment. And it's forced for them to save in that 401k. And my argument is use the 401k for a down payment so you can get into the housing business, if you will, get into a home, live in the home, start building your wealth here, and then continue to reinvest into the 401k. Take it out and use it. And I know that from my standpoint, they call it leverage, right? And I'm going to use my little analogy for leverage, right?
Yeah.
So if you've got a little baby on one side of a teeter-totter, and you've got a sumo wrestler on the other, what happens when that sumo wrestler sits down on the teeter-totter? That little baby will go whoop like this, go flying up. So the sumo wrestler is really the house, because the house, you're earning appreciation and equity on a big asset as opposed to just your money in the 401k that is smaller. So if you take $20,000 out and you buy a $450,000 home, you're earning appreciation on that $450,000 home. Whereas if you keep it in the 401k, you're only earning it on the $20,000. So you can replenish it. And if the average home buyer is 38 years old, they can still keep going on their 401k, still invest. They're not giving it up. They're just utilizing it differently and building that. And then, of course, the capital gains aspect of it, they don't pay capital gains on $250,000 of a gain on that house if they stay in the house for 2 out of 5 years. It's unbelievable, in my opinion, to use it for a home.
There's definitely some.
That's my argument.
What
do you think, Joe?
Well, there's definitely favorable tax codes, in real estate. And real estate, most people should have real estate in their portfolio. That's what I did as a young person. I bought my first home in my early 20s, and then I still have that home, and I turned that into a rental home. And then my home too, I lived in there, and I turned that into a second rental. Then I got married, and then that's a whole other story. But anyhow, to your point is that leverage, yes, you take an asset and you're borrowing money from the bank, but that asset, typically real estate, does grow at a consistent rate over a long period of time. And so you can tell whether or not the real estate market is overvalued or undervalued just by looking at the mean of real estate over a period of time. And I think actually it's right at the mean, right? Where it's not over, it's not under. I think it's right where it needs to be in terms of inflation.
So because we don't ever want to come off as salesy, even though people swear that that's what we are, right? We want people to
You're
see
educators, I hope.
we try, right? And despite our profession, our goal is education, right? So what would you say are the cons, if any, of utilizing your 401k for a down payment?
Well, let's talk about the mechanism. So when you borrow from your 401k, there's an administrator that has to do the administration on an annual basis. So you pay back yourself the interest on the money you borrowed. Okay, so let's say that
you're paying yourself back.
You're paying yourself back, and every administrator has their own formula of what that interest rate is. And it comes out of your paycheck, right? The money goes back into your 401k, but literally you'll get, let's say, 50% of that vested balance. And then you make that down payment. The risk is that what happens if the market on real estate goes down? Well, my hope is that you're buying it for your primary residence and you're in there for a longer period of time. The downside is if the stock market rapidly goes up, there could have been some opportunity loss or cost of the opportunity of that market doing well. And you got to be conscious of fees. When you buy a home, you don't want to look at, well, you want to take in consideration how much of your income is going into the actual mortgage, because you got mortgage, you got interest. But in a first time home buying, you also have a lot of other expenses, like furniture and utilities and that sort of thing. So where people I see get hung up is that they've overextended themselves and something happens in the home where now they're not able to make those obligations.
So the biggest fear is that you take out money for the 401k and then the value of the house is no longer what you paid for it.
Yeah, I mean, we saw that, right? In 2008, we had a financial crisis. People were throwing money into home prices, and the value of those homes were less. And now you're underwater, and some people had to walk away.
Well, that's the thing is, and I've always, and I want to hear your perspective on this, right? My question, because I was for me, I was young. I didn't know what I knew about real estate that I did now, right? But I always hear that they had to walk away, and I'm like, well, they didn't, right? Like they could have just kept, like we saw that the market very quickly bounced back, right? They were underwater for all of like 8 months, and then investors started buying up home, banks started selling bundles of loans, and very quickly the real estate market went back to what it was. So if they just didn't walk away, if they just kept making the same mortgage payments that they were making, would they have been in a better position, or was it smart for them to walk away?
Every person's unique, and just depends on their income capabilities and how they can recover, from that. Obviously, your credit takes a hit. The same thing with like bankruptcy. I see clients. I just had a client just recently who's super successful. She was making over $1 million a year, and her industry has suffered significantly, and she's racked up some significant debt.
Yeah.
And so for her, it might make sense to maybe file bankruptcy, take the hit, assuming that she's not going to make any purchases over the next 7 years, right? And now start fresh, where she's able to rebuild. And by the time, if I did a comparison of her, doing nothing versus doing something, the doing something, her net worth would actually be preserved and actually higher. So sometimes walk away may make financial sense, but not always.
And what's interesting, because I was there, right? I've been in it for 32 years, and 2008 was, it was a big, big financial crisis. And what ended up happening is a lot of people gave their home up through what's called short sale, where the mortgage was higher than what the value was. So they basically did what's called a short sale, but they could afford the mortgage payment. They didn't want to afford the mortgage payment because they didn't think there was value in the home. And you look 15 years later, real estate's long term. Yeah. Real estate is, if you're going to get in for 2 years, okay, that's a different thing. If you're getting in, you got to be in my opinion, for at least 5 years and upwards of 10 years to make it worthwhile to get into the investment. And so, but those houses that were underwater are now way above water in many cases. So it's just time. It's time in the market, not timing the market.
Yeah, we don't watch our house go up TikTok. It doesn't go up and down every day.
We don't watch a ticker, right? We don't watch the ticker.
Yeah.
But I feel like so many people, because they don't know these things, like my parents didn't know these things, like what I know now, and it's like someone could come out today and say, "Hey, Brandon, your house is worth $100,000 less than what you bought it," and I'm like, okay. What does that mean? What does that mean to me? I'm still making the same mortgage payments I've been. It doesn't really matter, right?
You still need a place to live.
I know eventually, because especially nowadays, where housing prices reach a certain level, that investors will just buy them automatically, right? So I know that there's like a floor that it's going to hit, but I think a lot of people don't realize that. Much like a lot of people don't know how their 401ks grow, right? Which is why a big thing that we're trying to do today is show them that there is advantages on both sides, but you have to know at least the basics of what it is.
You should be a participant in both.
Yeah,
correct.
I had a question for you earlier, but you were making such a good point that I didn't want to stop you. What percentage should employees be looking for when they're talking about 401ks with their employers?
You're asking like what percentage should you be saving for
Yeah,
your
you
retirement?
said there was like 3%, some 401ks are 3%, 4%. What should employees be looking for and pushing for from their employers?
Yeah. If you go to Caldera Wealth, we actually have a calculator where you can type in your age. You can type in, how much you want to put away into retirement per month. And then you could also tell us, this is the amount of money that I have already saved. And let's assume that you need 80% of your current income in retirement years. Hit calculate and it'll tell you. It'll tell you if you're fully funded to meet your retirement goals. And if you're not, it'll say, well, let's say you're only 75% funded. Well, how do I fix that? Well, I can retire later. I could reduce my lifestyle instead of 80, maybe 75%. Or maybe I need to put a little more money away, per month, or a combination of all three. And so it all depends on the individual, how much is it that they need and how close are they to retirement age. Now, if someone who hasn't saved enough and retirement age is like within 10 years, that number is going to be a lot bigger versus someone who's in their 20s. I always say retirement's always on sale, right? Because if you think about it, that power of compounding doesn't cost me as much. So I bought back when I was in my 20s. Back then there was this car manufacturer called Saturn. They're no longer in business anymore. But
My buddy in college had a shitty
still
old
have
Saturn.
Saturn?
He had a shitty old Saturn that we would pack 5 large men into.
Well, and they had the reason it was one of those companies where they had this guarantee that if you didn't like it, you can return it. And no other car company, and that's probably why they're out of business today. But anyhow,
No,
I
like
love that leather smell. It was a sports black car, and I just loved it. But I did the calculation. My car payment, put that into retirement year, or if I use the same car payment towards my retirement, how much would I have? And I would have like $1.3 million.
Jesus.
And I was like, are you kidding me? This is like my car payment. Okay, well, maybe I don't need a brand new car. And so it helped open my eyes to the ability that, if I can save 4% of my pay at the time, then I'm going to hit my retirement goals. Well, obviously, though, my lifestyles increase. And so my preference is more than that. And so, I just put a piece of my pay away that I could afford into my retirement account.
But in 401k, you talked about match, but isn't a 6% pretty good, 10% better?
Well,
in terms of thing? I know it's dependent, but
if you're younger, you don't have to do a bunch.
You don't have to do as much.
Right.
And then if the employer matches, you want to at least put in as much as what the employer would
that's
match,
free money.
Correct?
That's
'Cause
free
it's
money.
free money.
It's free money. You got to take advantage of the match.
So if the employer is going to put 3% in for you,
You
then
gotta
you
put
have to
3.
put 3%,
Yeah.
and that equals 6%. So it's 6%.
Take the free money. We always
It's
talk about free money around here. Take the
And
free
same
money.
thing if they're offering 4% as a match, then you put in 4%, and then you get the most free money that you can.
Awesome.
don't leave money on the
So
table.
we have a lot of self-employed people who watch the show, and obviously I'm self-employed. My wife's self-employed. If we wanted to start a Roth IRA, a Roth IRA, where would we start? Who should we contact? What's the best place for us to get information on these kind of things?
Well, even self-employed can actually have a 401k.
Really?
Really?
All right, put us on.
Yeah, we have 401ks.
Do you know a guy, Joe, that he can talk to?
I'm the guy. Yeah. So they're actually called solo Ks. Solo
Ks.
Solo
Okay.
Ks. Yeah. And so we have a program for folks that are self-employed.
Would you say someone who is starting from the beginning, right? Would you suggest or refer, or is there one that's better, a Roth IRA or a solo K? Are there advantages that may be beneficial to people? And if so, is it age dependent? Is it how much they're putting away? What would you say is the better of the two?
In 401ks, you do have the ability to put into the pre-tax or the post-tax. So there is a solo K Roth, but it's just one solo K plan. So in your solo K plan, you can either put into the pre-tax, meaning that you want to reduce your taxable income by the amount you contribute. So let's say you put $100 and let's say you put in 5%. So that's $95. So you won't pay tax on $100. You only pay tax on $95.
Yeah.
That's the traditional 401k. You pay tax when you pull the money out, but if you're young, I don't want you to pay tax on all of that growth. But however, you could be in a lower tax bracket when you retire. Now the Roth allows you to pay tax today, and I would argue that tax rates are really relatively low in this environment. And you put $100 in, or excuse me, you have $100, you put 5% away, so that's $5. Now you're going to pay tax on the full $100, but that $5 that you put away is going to grow tax free. And it's all grow tax deferred because it's in a retirement bucket. But when you pull that money out, including the growth, there's no tax. So the decision to whether or not have a 401k or a Roth or IRA depends on what is your contribution amount that you're considering. The 401k space, you get institutional share classes. Typically, we have the investment expenses are very, very low. In a IRA, a retail Roth, expenses could be a little bit higher. So if you could, and in an IRA, the limit's a lot lower than a traditional 401k.
Okay. Yeah. So I can just stop throwing all my money in index funds and Tesla.
Yeah, you need to go see
and
Joe.
start putting it somewhere, right? Because most of the stuff I know, I've learned myself, right? And never got the financial education. So that's why I know this episode's for our audience, but man, I'm like on the edge of my seat here. Yeah. I'm trying not to be selfish, but like Joe, you have opened a lot of eyes, especially mine. I am beyond grateful that you were able to sit here and share your information with us. At the end of our episodes, we do like what's called a dad rant. Because like what people know me on the internet for is being an angry dad. I basically am just trying to like yell at millennials to be better people.
He's
right?
good at it too.
But I'm very good at it. But what I'm going to say is not angry. It's disappointed, right? Every other week, we have Bill on to teach you guys for free on how loans work and how to build your credit. And he provides sources to help. And now we've brought on a literal financial manager who does this for a living, and he's very, very good at it. And they both have provided you guys websites, contact numbers for you to reach out and help. So at this point, if you're not willing to accept their help, you have to admit that you like being broke, that you want to be 65 and still having to work day in, day out, right? And they're here to take away your excuses. So Joe, for people who weren't listening at the beginning, how do they contact you? How do they reach you?
Yeah, they can go to CalderaWealth.com. That's CALDERA wealth.com. And on that site, you'll get to learn a little more about us, but also you can actually book your own appointment on the website and use that calculator tool. Have fun and play with that calculator. If you want to meet with us, we have a confidential profile we ask you to fill out ahead of time, so it makes the meeting go a little more efficient. There's no cost to meet with me or my team for an initial consultation.
Mm-hmm.
We're glad to help, but it's so important because obviously we don't know what we don't know, and there's so many aspects to financial planning.
Yeah.
So also the phone number is 702-616-2000.
We're gonna put all that information in. The information is free. You have nothing to lose but your fear and your excuses. And we know how much you guys love excuses. So let's help you guys overcome them. Bill, will you help them for free?
BillGaylord.com. You can book a free consult. And what I also want to say is if you're considering using that 401k, you don't know how to operate it, you don't know what the numbers look like, you don't know what penalties you'll have, you don't know what taxes you'll have, I can do an analysis for you so you can see if you take that money out, use it for a down payment, how much that house goes up in value, how you can grow your wealth, how you can take advantage of the capital gains deduction. It's a great program. And if you want that analysis, please let me know. Happy to put it together.
Guys, I'm telling you right now, as a guy who was homeless 10 years ago and has had to learn all this stuff myself, sitting in the room with smart people like this is how I got to where I am today. You just have to stop making excuses. You just have to start. I will help you for free. Bill will do a consultation for free. Joe will do a consultation for free. You have nothing to lose but your excuses. So please reach out. As always, Brandon from Vegas on all platforms. Everybody's information will be in the box below. Please utilize it. Please use it. We're here to help. If you don't trust me and Bill because we're, salesy, but that's okay. We got it. Joe is not salesy. Look at him. This man is a
This
professional.
guy is a nerd. He knows his stuff.
He is a
Backwards and
professional.
forwards.
I'm
Right.
very passionate. I think everyone needs a financial advocate.
100%.
100%. We all do. So, Joe, thank you for your time. Bill, as always, thank you for your
Thank you.
time. And today, it's not come and be my neighbor. It's come and be our equals. Come and join the financial world and learn what you've been missing out on. And we're going to welcome you guys to it. So, thank you for being here.
Thank you.